really did. I really did.
All right, listen. Peter Bookvar is here. Everyone's gonna be on their best behavior. Peter Bookvar. All right. Not to start this off on the wrong foot. Is it Blakely or Bleakley?
Bleakly, like something is bleak.
Bleakley.
Yeah.
Okay.
There was a guy named Bleakly like 30 plus
I was
years
gonna say
ago.
not a great name for a firm.
No. But
Why isn't this Bookvar Securities? What are we doing here?
There was a guy from 30 plus years ago. His last name was Bleakly, and they just kept the name.
Okay. All right. So you are basically the investment guy, the economy guy. You're the face. You're doing all of the things.
So I help the advisors with their portfolios. I manage 2 strategies myself with bond stocks, commodities, and so on. And I write every day on macro, obviously.
You have the job that you should have.
It's perfect because I love
perfect for you.
to invest and I love to research the macro and write about it.
It's the perfect gig. And where are you guys based out of?
Fairfield, New Jersey.
Okay.
But over the last couple of years, we've added advisors in different cities.
Okay.
By the way, Amazon up 15%. Did I nail it or what?
No,
Did I call that? Did I call that?
I said.
The setup is good. What was the EPS number? Because I saw they slightly missed revenue, but
Amazon doesn't
people
do
were feeling
numbers.
worse. Right.
They don't do earnings.
Because they never give an estimate.
Did they announce a split?
27.75. Wait a minute. 27.75. The estimate was for $3.77. Was there a typo on that?
Maybe something unusual on that.
Yeah, I guess.
Can I tell you something that you know why I hate the stock market? Because Alphabet's numbers were so amazing, and it gave back almost all of the gain because of Facebook.
Right.
Now the slate is wiped clean. Amazon has numbers probably as good as Alphabet's, but it doesn't pay that same penalty, or maybe it already paid it intraday today. How do you figure that out?
Well, I think what we're seeing here is you look at all the FANGs,
Yeah.
at least in my own opinion, Google has the best business model.
Yes, I agree with that.
Apple is dominant in that because it's Apple, but Apple, at least their biggest, the phone business, they need to resell another phone every year just to replace a lost one.
Right.
It isn't only the services part is recurring. Amazon, we talked about, AWS is amazing, but the retail business is highly competitive. Actually, Microsoft's probably close to Google, but Microsoft constantly has to come up with
Google has to
something
sell
new.
Android phones. Like they need people to sell Android phones.
Yeah, but I'm saying the click advertising search business is probably one of the greatest businesses ever.
Google has 10 different businesses that are $1 billion plus revenue a year.
Yeah.
That doesn't exist in the stock market.
No, it's
only
unbelievable.
Berkshire Hathaway.
Or a Procter and Gamble.
I've got the report.
Procter
We're
and
not
Gamble.
gonna.
Yeah.
We're not going to dissect all this right now, but this is interesting. Free cash flow decreased to negative $9 billion for the trailing 12 months compared with positive $31 billion. I heard Gavin Baker on Patrick O'Shaughnessy's podcast said they spent more on CapEx in the last 12 months, than in the last 20 years.
Because they're building out their delivery business.
They
And
hired
that is
500,000
hugely
people last
expensive.
quarter.
And that too, yeah. Which a lot of that also with respect to their delivery. Did they give any guidance to the following quarter?
Let's see.
It's a new CEO too.
Net income, $14 billion in the fourth quarter. Again, $27.75 a share, compared with $7 billion or $14.09 in the fourth quarter of 2020. So net income doubled. It's usually a good sign.
That's a pretty good sign. So they 1 out of every 153 Americans works at Amazon. Did you know that?
1 out of 153. So they're probably closing in on Walmart as being the largest private sector
1.3 million employees.
Actually, maybe they passed Walmart because I think Walmart was about a million.
They could, yeah. I mean, either way, it's enormous.
Yeah.
Up 16%. Let's go.
Is it up 16%?
AWS up.
Christmas is saved.
AWS up 40%. 17.
Which I think is better.
18 billion.
Mid-30s.
18 billion. What would that be as a standalone business? That would trade at a
AWS
multiple, right?
It would be in the NASDAQ 100.
18 billion of revenue they're doing?
Quarterly.
Quarterly.
Was that a full year number?
So it's 70 billion plus of revenue?
I'm looking.
No, it can't be that big.
No.
That seems too big. That might be 2021 full
I mean, that's
year.
at least well, now with reduced multiples, maybe a 10 times sales multiple. 15 times maybe.
Like tomorrow would be 9 times.
Can't find it.
Should I play waiting music on the
sorry.
podcast?
No, we should
going.
we should actually do the show. Right. We're gonna get into more of this stuff on the show. So, but I want to give Peter like a very warm introduction. So, I read you every day. Your email blasts are essential for me because you speak plain English about tons of different economic data series that come out, and you really digest every. Is there anything you don't read? Like, is there any economic data that you're like, no, this isn't important? Because you're encyclopedic to me.
Well, what I try to do is it says, okay, if I'm going to look at the world from an investing standpoint, what am I going to care about?
Okay.
And I say, okay, I'm going to write about what I care about. And I hope others care about the same thing. Like,
Yeah.
I know to talk about, like, let's just say we talk about Asia. So I'm getting up in the morning, I'm seeing what went on overnight. I know South Korea is a pretty important country right now.
Yeah.
Samsung making semis. We know they make a ton of cars. We know Taiwan is hugely important because they're a semi business. So what their exports are now relevant to the rest of the world.
That's right.
What the Philippines says, I'm really not that interested in because it's just not relevant.
Right.
Singapore is now a growing important country because people are moving from Hong Kong and it's becoming
Crazy
a bigger
wealth. Insane wealth.
a presence in Asia.
Yeah.
So that's now relevant. But what happens in Malaysia, I'm not necessarily. Now, Malaysia, of course, has a semi business, but it's not on the same level.
Okay.
Yo,
Europe-
guys, sorry to interrupt.
Yeah.
So AWS, $71 billion annual run rate.
Oh, it is.
Okay,
that.
so
So,
10 plus.
so Facebook trades at 8 times sales before the plunge. AWS would probably trade at 10 times sales.
10 times sales, but their retail business is probably a fraction of that.
100%. So AWS as a standalone business could legitimately be bigger than Facebook.
Right now, yeah.
That's nuts.
Does Facebook run on AWS?
I mean, they must, I would think.
Actually, a good question.
I doubt they're using.
Yeah.
Maybe they use
Google
Microsoft.
or-
So
Yeah,
AWS could be
or-
bigger than Facebook as a standalone business.
Yeah, at least right now.
Wow.
Okay, so you're crunching all this stuff, and then you're trying to write like 2 or 3 paragraphs, not bury people in data for the sake of data.
Right,
And then
'cause
you
I know
do a
we-
chart, and it's amazing.
Because I know we all get flooded with stuff, particularly
Yeah.
in the morning when your email box just blows up.
Dude,
and
the sell side stuff alone, it's unbelievable how the volume of research.
I
coming
still
out.
see 150-page reports in
Yeah.
one sector. I'm like, why
is
do
reading
this?
this?
I mean, there's a lot of charts and numbers in there, but who's going to get through the first couple of pages? So I just try to make it relevant for a couple of paragraphs. And if it's not in there, I don't find it relevant.
Okay, so give us like the 10,000-foot view, the state of the U.S. economy as of winter 2022. Like, where are things right now? Because I don't think everybody agrees.
So I think right now the U.S. economy has characteristics of being in like the sort of the 7th inning of a recovery, in the sense that usually you have a recession, you have 8 to 10 years of runway of growth, and then you run into an issue, you have a recession, and then you have another 8 to 10. With the unemployment rate 4%, that's sort of late stage.
Yeah.
With inflation, late stage. There's so many late stage characteristics, even though this stage is unlike any other. So I necessarily can't compare.
Because it
So
kind of
weird.
started in the summer of 2020.
Yeah.
And we're late stage.
Right, that's
we
the
did a whole
bizarre thing.
cycle. We did a whole cycle in under 2 years.
Right.
Okay.
The whole thing is weird. We put the economy in a coma, then woke it up and said, go back to work, and everything got jumbled. And it's hard to use this data versus like historic comps. It's also
Without
weird.
question, because everything's getting screwed up now with the inflation story and the supply story. And so on the demand side, consumers are getting hurt. You know, I posted a chart this morning that the CRB food index is at a record high.
Yeah.
Now, if we have to pay an extra 50 cents for a box of cereal, it doesn't matter to us.
Yeah.
But the average person who's making, 50 grand,
They feel it.
it
It's real.
matters to them, and it starts to impact their behavior. And even taking that one step further, if you're making even more, but the standard thing that you usually are used to being at this price ends up being that price, you start to react differently.
Even if you can afford it, it's no big deal. You notice it.
We know if you're in sales, what is somebody like? They like a deal.
There's no.
It may
deals.
not even be a real deal, but if they hear that it's a deal, they respond to a deal. So if there are no deals anymore, things are getting marked up and they're responding to that.
I got punched in the face this summer with my lease on my Tahoe. Basically, I wasn't going to be up for a few months, but I started getting nervous that maybe by the time I'm up, there won't be another truck.
Right, and you have to wait.
So I went
6
I went
months.
into my kid, and I'm like, I did a car with him last time, and I'm like, listen, what's the situation? Because the situation is you could put an order in now, and if you're lucky, in 6 months, I will call you and say it's available. And so I did it, and I gave them money. And then a month later, he calls back. He goes, listen, forget about your truck. You're never getting it.
Wow.
I got another truck that somebody ordered and doesn't want. and you're my third call and you picked up the phone. If you come in right now, we could do this deal. And I'm like, great, what's the price? He goes, the price is whatever the price is. And no offense, there's no manufacturer rebates now. Normally,
How much over MSRP was it?
whatever it was, I'll tell you this, it was 15 or 16% over my last lease.
That's not even that bad.
It's not even that bad. It could have been way worse. And he explained most of the time there's something coming from the manufacturer where they want to move it. He's like, now they'll gladly keep the truck. So there's no deals anymore for anybody. So I said, listen, TJ, you won this time, but I'll be back in 3 years and I'm going to punch you in the face. So it is what it is, but
So
I
you
agree
grabbed
with
it.
you. Of course I grabbed it.
Yeah.
But you're right. That sticker shock changes the way you behave in other aspects of your life. And you talk about sticker shock in housing. So what do you mean by that? You talk about first-time buyers. They're like, what the hell is this?
Right. So when you look at sort of like a chain within the housing market, you have that first-time buyer that allows an existing homeowner to trade up if they choose,
Right.
and whether because they got to start a home and they want to sort of graduate to a bigger home because they have a family, have kids. Without that first-time home buyer, sort of clogs up that chain, and now you have home prices that are up. Now they're receding a little bit in terms of rate of change, but 18% more expensive than a year ago. It's completely offset the benefit of lower mortgage rates.
Yeah. Actually, it's worse.
It's actually worse.
The down payment is
Yeah.
crushing people.
So, but now you have mortgage rates going up to 3.75%. And while maybe your monthly payment may not go up that much, it's still a shock because you also have to pay up 18% more on your down payment. But on the other hand, you're seeing rents going up for new leases at 18%, renewals going up 7 to 8. So people are juggling, like, do I rush into a home and lock in that mortgage rate, or do I suck it up and pay that higher rent? It's really a shame. And one of the, obviously, the consequences of low mortgage rates and cheap money, but it's unfortunate that a lot of first-time buyers,
If you talk to,
it's difficult.
So we talked to Logan Motoshami, and he knows housing. When you talk to him, he explains, yes, of course, dropping interest rates and then flooding people's bank accounts led to a massive boom in real estate. But it just sped up one that was going to happen anyway, because we have 3.5 million fewer homes than we need. The boomers are competing with their grandchildren at this point for that. They're not leaving.
Well, the $1,400
And we're not building more homes at the rate that we normally would because it's too expensive. You can't get labor, you can't get materials. So it's going to be like this for a while. Doesn't really matter that much where the mortgage rate goes.
I
What do
think
you
the
about that?
fiscal response is not the fiscal response did not do this, right?
It might have jump-started it.
No, it didn't. The stimulus checks did not help people come up with gigantic down payments. I think it's people wanted to get into a house.
It was low mortgage rates.
Low mortgage rates, no doubt, and
Yeah.
it's 75 million people like me that need to get into a home for the first time. This is, I think,
People leaving cities too.
this is, I think, the important part about this whole inflation discussion.
But
is
also,
that
COVID screwed up the whole supply of existing homes. You know, if you're trying to get through COVID, you're not necessarily, and your kids are out of the house already. You're an empty nester, where you would be sort of a natural downsizer.
Yeah.
Maybe you move into a 55 and older, or just smaller space, and you would sell to a first-time buyer.
Yeah.
Well, COVID kind of threw that up in the air, and maybe you stay for a little while.
That's right.
But when you think about monetary policy, that's what it does. It pulls forward behavior.
Yeah.
It doesn't grow the economic pie. It just alters the timing of it.
Okay.
You look at the late 1990s. Yeah, at some point we were going to need all that fiber optics that were, planted under the sea, but because of the bubble, it all happened in 2 years.
We would have needed it eventually.
Eventually, housing in the mid 2000s, we would have needed it eventually. It just got grouped together because the Fed encouraged you. Because that's what the Fed does. The Fed says to everybody, "I'll make a deal with you. I'll lower your mortgage rate today to make you buy that home today, instead of you waiting to save up." And then, and instead of waiting 6 to 12 months, I'll encourage you to buy that car because I'll finance for you cheaper if you buy it today instead of waiting till tomorrow. So that's what monetary policy does. It just alters the timing.
So that's what's different about a bubble in houses versus a bubble in stocks. First, you buy a stock at the wrong price, you can't live under it. It doesn't protect you from the rain and the elements. It's a stock.
Right.
You buy a house at the wrong price, but you can afford to stay. You still end up with the house. It's too, like, to me, it's like.
But there's a similar characteristic, though.
Which
It's
is
your
the
time
pull forward.
and your time horizon.
Right.
That's the key to investing is your time horizon. I mean, Warren Buffett just had a longer time horizon than everybody else.
Right.
So he therefore invited declines. If you were going to live in your house for 30 years, it doesn't really matter what you're going to pay today.
Okay, so the rate of change is coming down because home prices were up 19% in November, and then 18 and a half, and now 18. So we're going to lap the second half of 21 in the second half of 22,
Right.
And those rate of change numbers will collapse, and maybe home prices will be up 4 or 6%. Is that reasonable?
That's where it could potentially settle out at, and that's going to be the same for all of inflation.
Yes.
The inflation will peak probably February, March, just on a rate of change basis, and then we'll start to moderate.
Yeah.
The question is how quickly does it moderate?
Can you explain this to the audience? Everyone, the thing that I keep hearing is like, oh no, you don't understand. Inflation is not going away because wages are sticky. Yeah, we get that. Like somebody doesn't get a raise and then lose the raise because inflation cools off. We understand that. But the rate of change is the thing that matters.
Why?
Do they get because if you have to pay somebody $18, Amazon's paying $18 an hour for all these warehouse and logistics workers. Fine. If they have to do a raise for all these people commensurate with inflation of 7% every month forever, then of course the company will cease to exist. But that's not the rate at which the demand rises. It rises much slower and then eventually levels off. So everyone that got a raise in 2021 to come back to work doesn't just get one in 2022 because they feel like getting one.
Right. We'll have to see what the circumstances are because that 7% raise may not be replicated right in the next year.
But I guess
if you look at look at the 80s and 90s, where inflation came off of this peak in the late 70s, but inflation kept rising every year. It was just the rate of change
Duncan,
that slowed.
you're not getting another raise next year. All right?
Yeah, but I guess the worry is that if prices do keep increasing, then people will demand raises.
Well, yeah, that's the question. And I think the question also is we know the rate of inflation will slow, but it's how do central banks respond to wherever it settles out at? Where do valuations settle out, wherever it is? Because and something that I've written about is that when you look at the global world, we kind of partied like inflation under a circumstance where inflation was low, 1 to 2%.
Yeah.
And I always like to say that central banks, when inflation is low, basically have a hall pass. They can do anything and they can go anywhere they want. They can experiment with policy. They can go to negative interest rates. They can expand their balance sheet, whatever. But once inflation sort of becomes an issue, they have less flexibility.
Yeah.
So, like, let's just say
And
that
they have to speak differently too.
yeah, let's just say the 10-year yield was 4 to 5% today, which historically would have been normal, and the Fed funds rate was 2, 3, 4%. If inflation was 3%, I would say, okay, not a big deal. Interest rates already sort of reflect that.
Yeah.
It's just the context at which this inflation is coming with negative rates and zero rates and rates being general and the amount of debt.
It's weird.
And just the culture that has sort of fed off low
Dude, they're
rates
still
and private equity feeding off low
They're
rates.
still buying
and it's-
assets right now. Right now, the Fed is continuing.
Right.
So they announced the taper. They basically announced liftoff. Like we pretty much know it's March.
Yep.
But as we speak in February, they're still buying assets
I think
in the open
60
market.
billion. Is it 40 and 20? Of
Now they're
treasuries and
down
more?
to probably 30 and change. And
a lot.
Brazil last night raised interest rates by 150 basis
Yeah.
points
Yeah.
in one shot.
And Lagarde might actually raise rates at some point in our lives.
Yeah,
it
and
sounds like.
they may go from minus 50 to minus 40.
Well,
Right.
England did a 50 basis point hike.
No, they did 25, but
25?
4 out of the 9 members voted for 50.
Oh, that's what it was.
and
okay.
they said they're going to start shrinking their balance sheet.
Okay, so now I heard Powell say, I think he said it more than once. He was talking about like the pace at which he's going to move, and he kept saying that he wants to elongate the cycle. But if we pulled forward a full cycle's worth of demand for dishwashers and cars and housing and like, is there even a cycle left to elongate? Is he dreaming?
Well, it's one of the fallacies when we see with Japan of keeping rates low for a long period of time, where this forward guidance of the Fed or any
Extending
central bank
this-
telling everybody we're going to keep rates low, and they think that's stimulative. But it's not, because after you get the initial rush of people taking advantage of low rates, then that sense of urgency ends.
Yes.
And hey, if rates are going to stay low for a couple of years, I don't need to act now.
Why do I have to buy this
I
now?
should wait. So
Yeah.
that's why this idea of central banks keeping rates low for a long time stops being stimulative. And then it starts to negatively impact bank lending. We take for granted that
Sorry.
that
Snap's up 40%.
Oh.
It was down 23% today.
they reported also.
It's up 40%.
It's a casino.
It's amazing.
On
Did
no
the fundamentals
news.
of Snap change by 23% negatively today?
First ever net profit. The stock pops 42%. I thought this was like a typo or something. Sorry, Peter. Let me ask you this: do you think I am of the opinion, and the market could prove me wrong very quickly, that there is a natural cap at interest rates because the demand demographics is so the tidal wave will overwhelm interest rates rising. I don't know where that cap
How
is.
much money there is that wants a risk-free rate of return?
So where does it? How high can the 10-year get? Like if the 10-year went to 4%, I would be like pretty surprised. Obviously not shocked. Oil went negative, but like I would be surprised.
Unfortunately, we're not going to know until we get there, until something breaks. No one had a prediction that in the fourth quarter of 2018 that a 2.25%, 2.5% Fed funds rate was going to freak everybody out, but it just got to
Is
that
that
point.
the new ceiling, though?
We don't know until I think a big part of where, and I've talked about this in my notes, that a key part of where U.S. yields go on the long end is where European rates go. Because where's the German 10-year going to go?
Well, it's 10 basis points.
It's now positive. It's now positive. You know what?
But nominal or real?
Nominal. It's 13 basis points
real,
today,
never.
Josh. It went up 10 basis points today.
I know.
So if the German 10-year goes to 50 basis points or 1%, which is crazy low,
And we could be 3%.
maybe we can go higher just because, I mean, when you think about negative rates or negative bonds, I should say, it's the epitome of bubble in terms of the central bank turned what's an old school asset into a liability for the owner.
Yeah.
The owner of that bond, it's now a liability.
Peter, isn't it the opposite of a bubble? When you have people
Well, when I
that are
say bubble-
so nervous that they're willing to buy a negative yielding sovereign bond, is that bubble-ish behavior?
Well, I meant bubble in the sense that the only way you make money is to sell to somebody else who's willing to pay a higher price
Yes.
because you can't make money from the
But
yield.
to me, that was more so than the stock market. There was a point where 13 trillion, I think that was the high, 13 trillion in sovereign bonds were trading at negative.
No, it got almost to 20.
So, okay, so let's use 20. So $20 trillion was such scared money that it was willing to pay an interest rate back to a government rather than be at risk. How could that coexist with a speculative mania? It almost feels like it can't.
Well, a lot of that money also had to own them, like because they were considered
Mandates.
high quality collateral.
That's right.
So a lot of the European banks were sort of forced to own them. And what the ECB did with the banks in Europe, they said, you know what, guys, I will pay you to lend money. And I will pay you minus or 50 basis points or 1%. So what the European banks would say, okay, I'm going to get one minus 50 basis points, and they would buy a German bond minus 30, and they would make money on that spread.
Right. I mean, our Fed is doing a version of that when they're paying interest on reserves and they're incentivizing banks to park money. I mean, should that have been rethought this time around?
What would you do if you were at the Fed right now?
Well, I think it will be rethunk when the Fed starts raising interest rates, and you're going to have members of Congress saying, why is the Fed paying banks billions and billions of
It never
dollars
made any sense
to
to me.
park their money at the Fed?
Yeah. Isn't that money supposed to be doing something?
It's supposed to be doing something. And what's happened in this country is that because of the robustness of our capital markets, if you're a big company, you had easy access to the capital markets. If you're a small business, less than 20 people, you need a loan from a bank, it's really hard to get one.
Yeah.
And if you get one, you got to personally guarantee that loan.
That's
you
right.
got to put up your house, you got to put up whatever assets. It's really difficult.
That's what we had to do. We had to literally pledge our personal collateral.
But if you're a frothy high tech company, and there's no covenants in any loan that you're given, and people are writing checks without even reading your business plan.
Sell more stock.
So there's quite a difference in that, and I think a lot of that is because of what the Fed's done with the yield curve. It's hurt conventional bank lending. And that happened in Europe. That was one of the fallacies of negative interest rates, is that if you damage the profitability of banks, well, then they have to build in a higher margin in their loan to you, and the net result is less lending. And that's why the European bank stock index is down 80% from where it was in 2007. And 80% of the financing in Europe is from the banks.
Yeah. Who do they think they were helping? Because if you crush your own banking sector and you make it impossible for them to earn a profit,
right?
Why do you then expect they're going to turn around and start taking risk?
And now what's turned into that policy of trying to and thinking that banks would somehow lend, now the ECB is now just a financer for European governments.
Okay.
So getting out of that for them is difficult. And people can argue that the Fed has done the same with our treasury.
So I want to go to interest rates and the consensus. I think these people are going way overboard, but maybe I'm sure you disagree with me. But this idea that they're going to hike now at every meeting, why do we think that they would even have to if we know that we're going to decelerate in inflation? Like we almost have to. So let's put this up. Let me read this. In recent days, investment bank after investment bank has published revised forecasts. They all predict the same thing. Federal Reserve will raise interest rates at a quicker pace than anyone anticipated a week ago. The latest is Goldman Sachs, which now sees 5 hikes this year, up from 4, joining Deutsche. Bank of America thinks the central bank will be even more aggressive. It predicts 7 25 basis point hikes, which would be 1 for every remaining FOMC meeting. That would put the Fed funds rate at 1.75 to 2% by year end, essentially hiking up. Blah, blah, blah. All right. I don't think they can do it, even if they wanted to, and I don't think they want to. What do you think?
I think the Fed is not sitting around saying, okay, what do we need to do this year? All they're doing is saying, what do we need to do now? And they know we need to end QE in March.
Yeah.
We need to hike rates
So
in
that's in the
March and
market.
maybe May, and then we'll see what's going on.
Okay.
Now, of course, raising twice, you still have a low Fed funds rate, but the Fed is going to is going to look at this in short-term fragments instead of saying, "Oh, I need to raise every meeting." They're not looking that far in advance.
What are they looking at? Personal consumption and expenditures. What else?
I think they're
500?
trying. So we are living in, and we have for years, a negative real interest rate environment.
That's right.
And as long as you have negative real interest rates,
for
you're highly accommodative.
So for the listener, I know it's not really the inflation rate anymore, but 7% inflation with interest rates at 0, basically in a money market fund, you are earning is this right? You are earning negative 7% on your money.
Yes.
So you are losing 7% of your purchasing power if that inflation rate persists.
Right.
If the Fed takes rates even to 1% and a 7% inflation rate persists, congratulations, you're only losing 6% of your purchasing. So that's real rates versus nominal. All right, go on.
So in the 1970s, real rates got as low as about minus 5%.
Right.
So just context of where we are today. So the Fed has to balance a bunch of different things. They have to
get Joe Biden reelected.
So an election year matters.
I know that.
If you look at 2016, so Janet Yellen hiked rates December 2015. We went into 2016 thinking she was going to raise another 3 times.
Yeah.
Then there was a China slowdown, and everyone thought, okay. Then she backed away. I'm not going to raise. We had to see what's going on with China. And then conveniently, she didn't raise until the month after the election.
Right.
So yeah, if we get to the summer and the economy's looking wobbly, stock market's wobbly, that's going to affect what they may do, because we also know that new governors are coming on, and they're going to likely be more dovish.
They always come on dovish.
They're
right?
going to be more sensitive to growth, but that's the difficult balancing act. Is inflation's still going to be high, so how do you back off? But you don't want to hurt the economy, and where are markets going to be? Where are credit spreads going to be within this?
Biden's ratings right now are
terrible,
as low as Trump's ever got, and I think almost all of that can be attributed to inflation.
Well, let's pretend for a second.
Do you agree?
Do
you agree with that?
Yeah, for sure. It's 100% that.
Because what else is he doing? He's doing nothing.
It's inflation that is what everyone is now paying attention to.
Right. Okay.
But let's just say we're in a campaign meeting for Biden, or for going into November. Is it a better sales pitch to say we got inflation down, but the stock market's down 25, 30%?
No.
You stupid
or
son of a bitch.
inflation's still high, but the stock market rallied. That's going to be a
Oh,
big
he loses.
discussion
He
here.
loses either way.
Well, that's why they're in a tricky place, because also if they do go too quickly and the market falls apart, that could affect the economy.
The Fed has made financial conditions that third mandate, and that went back to Bernanke. Bernanke said QE was meant to ease financial conditions, aka lift stock prices. That was a direct intent of the Fed. Outside of 0809 when they were just trying to save the MBS market and the housing market, but QE 2.3 was specifically meant to raise asset prices.
2-year Treasury in the last 12 months went from 15 basis points to 115 basis points. How much of the Fed's work in tightening financial conditions has already happened? Like, are we 10% of the way there just on market movement?
Look at the what you just had up.
Put that
the
back
4 to
up.
7 rate hikes.
Yeah.
Well, we've already had 4 essentially.
You basically had 4.
We basically had 4 already. So it's in
those
there.
are market enforced rate hikes.
So that's what I'm saying, that we did a lot of that already.
But what's not priced in is what is the economic response to this?
We don't. It's too soon.
We don't know yet.
Yeah.
And we're beginning to see some inklings that inflation is affecting
Facebook crashing 25% a day.
What's the economic impact of that? If you're an employee at Facebook and your options are now partly out of the money, or
one less Lambo this year. It's not going to be good.
What's the economic impact of now inflation and falling real wages?
But don't worry, Amazon added $200 billion in market cap, so it's a wash.
Yeah, it's a wash.
They took it from Facebook.
We're good.
All right. So do you think 7 rate hikes is a ridiculous call, or could it actually turn out to be?
I think we're more likely to have a rate cut than 7. Do you agree with that, Peter? Or is that
I
this
think-
economy?
I think that the economy is, like I said, 7th inning. You don't want to start hiking when you're in the 7th or even 8th inning of an expansion.
So then terminal rates for this cycle might not get back to terminal rates for the last cycle, which we said was 2.5%.
Right. And what could dictate how many hikes also can be where the S&P 500 is. Where's the high yield spread to treasuries?
All right, so that's important. I'm so glad you brought that up. Before we move on from this topic, I want to get your take on that.
But those aren't moving, right?
Most smart people will say, and not without reason, the thing to watch more than anything else is credit spreads.
They're still on the floor.
There's still too much money out there.
Chart here, yeah. So right now, if you look at the markets, essentially starting last year with a lot of the high flyers, all we've had so far is a valuation rethink. You know what? I don't want to pay 40 times sales. I'll pay 30. Well, that's a 25% decline in the stock. And then, you know what? I'm only going to pay 20. Well, that's a stock that's got cut in half. And if you're Peloton, I only want to pay 10 times sales. Well, now you're down 75%.
Duncan, pull up this chart.
So this is the spread to treasuries. And you can see we're beginning to curl up a little bit.
This is high yield bonds.
This is the Bloomberg high yield relative spread to treasury.
Over what you would get in a comparable treasury.
These are like forced buyers, right, Peter? Nobody's willingly doing this.
Well, right.
It's going
but
up.
yeah, it's beginning to tick up.
Okay.
So, but we can't get alarmed just yet, because you can see pre-COVID it was about 400 plus 500 basis points. But this is something we need to watch, because if this starts to widen out,
it matters.
That means people are starting to get worried about the economy.
But that's a real sign of stress in the economy.
This could be the most important thing.
Because that's people withdrawing debt financing for businesses that they're no longer confident in.
Right.
That's what that would symbolize.
But we're already beginning to see in VC investors are now beginning to tighten their valuation analysis, whether that's with a new investment or talking to their existing portfolio
for
companies.
the growth companies, for sure.
Yeah, I mean, I was reading the other day, one company was trying to raise at an $8 billion valuation. Boom, it's already down to 6. Now, 6 is still very generous, but that was an immediate
We'll go in there.
drawdown.
We'll go in there next. Duncan, pull this global venture funding.
This is not going to affect the seed companies, I don't think, but the later
It
stage
affects
companies.
the psychology.
I agree with that.
That if you're going to go into a pitch meeting now and show a slide deck and expect a certain valuation, that conversation is different than it was 6 months ago in terms of valuation.
Sure. My point is, I think companies can still raise 20 million. The companies that are raising at 10 billion, those are basically public-private companies.
Yeah, if you've got a
they get
business
killed.
model, you'll still raise the money.
Yeah.
It's just a matter of what valuation.
So this is global venture funding. This jumps from $294 billion in 2020,
Which is already a record.
during a recession.
Which is already a record.
It jumps 111% in 2021. Global venture funding hit $621 billion. That is one of the most insane jumps for any asset class that I can think of. This is actually from Galloway. In 21, startups around the world raised 621, 111% increase from the year before. There are now more unicorns than ever. 959 companies worth $1 billion in the private market, up from 569.
That's about to be That's about to be 750.
and put a real life business behind those numbers. You know, we the beauty of at least the U.S. economy is the entrepreneurial culture and these amazing things that people invent. But are there double the amount of great businesses out there?
No,
Exactly.
of course not.
So there's a lot of money being thrown at less than great businesses at higher than should be valuation.
But it's equity money, so in fairness, nobody's that worried about it. It's not debt financing in venture.
The other thing is, though, the Great Resignation was a big part of 2021. There's a lot of people that left Google to start their own thing in 2021. We might not see that again.
The big headline this week, Peter, was $30 trillion in U.S. debt, and I know you wrote about it. So a regular person who doesn't understand that the size of the economy has grown somewhat commensurately, it's a shocking headline number, obviously. Like, what do you say to people that don't eat, sleep, and breathe this stuff like you do when they read U.S. national debt tops $30 trillion, record red ink fueled by spending to combat the coronavirus comes as interest rates are expected to rise, which could add to America's costs. It's not. I don't think the articles are being written to be deliberately alarmist, but that number is alarming.
It's alarming relative to the size of the U.S. economy.
Right.
But it's one of those things that it doesn't matter until it does.
Okay.
Like in the 1980s, people were going bananas over the exploding U.S. budget deficit.
Yeah.
And it was going to crowd out private investment.
Deficit has not mattered in 40 years.
Hasn't mattered, and it doesn't matter until it does. Now, it'll start to matter if interest rates go up, because now on that $30 trillion,
interest expense
for
goes
every
up.
100 basis points, that's another $300 billion. Now, that matters because the U.S. government takes in a certain level of tax receipts.
Yes.
And if the interest expense component starts to go up by hundreds of billions of dollars, then budget deficits start to really go up. And that's when it potentially could matter. It could matter in where the dollar goes, because if you look at a 30-year relationship between the budget deficit as a percent of GDP, there is a correlation with the US dollar. So if budget deficits don't contract at all and they stay very wide, the dollar could weaken, which could then influence inflation and can then have a ripple effect into the economy and so on. So it's one of those things that it sounds alarming, but it's been alarming for 30 plus years.
All right, so the MMT people, I'm reading in the middle of Stephanie Kelton right now. The MMT people would say Japan's debt to GDP for a long time has been like 200%, or where is it now? Debt to GDP
250.
250%. But in reality, Japan can take out the spreadsheet and instantly convert the JGBs and all of that debt into yen with an entry in a ledger, and really it's just one out balancing out the other. And the United States could do the same thing. We could just decide, okay, there are no more treasuries. We're swapping that all out. Here's your cash back. Like I think the way she phrases it is, dollars are green bananas and treasury bonds are yellow bananas, and they're interchangeable. It can't be that simple, can it?
No, it's not that simple. Well,
Okay.
first of all, the first fallacy with MMT is they make the assumption that the government spending has a multiplier effect, more than one, and that it's be efficiently spent and will be economically stimulative more than just the short term.
Yeah.
Well, I've seen enough studies that the multiplier on government spending for most spending is less than one. So in other words, you're getting less than $1 back for every dollar of government spending you're getting.
Right.
As opposed to a private business that's going to spend $1 and they get multiples of return on that.
Yeah.
So that's the first fallacy with MMT. Then the second one is, well, if we get inflation, then we'll just raise taxes to slow growth and that'll cool inflation.
Right.
Well,
what
good luck
politician
with
is
that.
able to just do that?
Right. And then they say, well, if that doesn't work, then we'll just cancel all the debt.
Right.
Well, you can't just cancel it, especially when 35% of it is owned by foreigners.
You can't cancel it. You can replace it with dollars instead of an instrument where a return is required. You can
You
just
still
say,
have to pay back the principal of those bonds. I mean, you're going to call up the teachers' union pension fund and say, we're not going to give you back your principal.
right. It's hard to imagine how any of that would
Yeah,
work in
I
real
don't.
life.
I don't even know. I can't even think through the logistics of that.
Right. Okay. So you don't think that this is something that's going to matter all of a sudden? If it hasn't mattered in 40 years with all we've been through, the deficit I'm speaking about specifically, you don't see this as a 2022 make or break moment for that?
It will if rates start to ratchet up. If the 10-year goes from 180 to 280, like I said, that extra 100 basis points is $300 billion of extra interest expense. If the Fed actually raises rates to 1.5 to 2, because the government debt, the average maturity of U.S. Treasuries is only about 6 years.
Right.
So the interest expense of the U.S. Treasury is very sensitive to what the Fed does.
And they have to roll it.
And they got to constantly roll it, and they're going to be rolling it at higher interest expense, higher interest rates, and that's going to be more costly for the government. And then we'll get to see how does the dollar respond to perpetually high budget deficits. And like I said, if the dollar rolls over, that will then exaggerate the
hasn't.
inflation story.
It's interesting that the dollar's been so strong.
No. All I'm saying is that the dollar will be sort of the thing that we have to watch in terms of the impact of excessive debt.
30 trillion is a hilarious number. It's literally incomprehensible. But those liabilities for the government are an asset for investors, right? So we're not seeing that side of it. And I
Meaning
just think,
what? It means those are treasury bonds that are sitting in people's accounts.
yeah, that people are getting interest on. So yeah, listen, if the 10-year goes up meaningful or the debt, the servicing costs go up meaningfully, it's going to matter. But if we look at interest expense as a percentage of like the debt, it's still pretty low.
Right, because rates are so low, servicing costs are very low.
Right.
That's why it doesn't matter until you get a rise in rates.
That's the only reason why you could do rounds and rounds of stimulus and then do Build Back Better. The only reason any of this hasn't fallen apart is because you can finance it at the rate that you can right now.
Because the Fed has rates very low, and they've sort of enabled Congress to spend this, just as the Bank of Japan enabled the Japanese government to spend all this money for decades.
Well, we also see like people that don't know about this might see $30 trillion. That's bigger than our entire economy. How are we going to pay that back? Well, it's not a bill that comes due next January.
You never have to pay it back as long as you have a printing press.
Your kids will pay it back.
You're just going to constantly refinance it. Just a question of at what rate do you refinance
But
that
hold
debt?
on. But Peter just said the average maturity is 6 years. It's not like we're dumping all this on our kids.
I'm just kidding.
I know.
That's the thing that people that pretend to be conservative say, and then they authorize massive tax breaks for people.
Well,
that
guess
don't really
what?
need
And
them.
you know what else they don't show when you're talking about 30 billion or 30 trillion? They don't show the assets of the consumer. Consumer finances have never been in better shape. Total assets, according to JP Morgan, this guide to the markets, 162 trillion. Let's say that's elevated because stocks, real estate, whatever. Fine, if it's only 130 trillion, 110 trillion. People never talk about the assets when they're talking about the liabilities.
Right. The same is also with Japan. Japan is a net creditor of the world. They own more of the rest of the world than the rest of the world owns of them. But the U.S. is the largest debtor nation in the worord. Foreigners own more of us than we own of them.
Oh, but China's been selling our treasuries. So people say, what happens when they go to dump it? They have been, right?
They've been selling, or they've been letting things mature. They just haven't been expanding it.
So they're about 11. They're about 11% of the treasury market.
So they may not outright be
It's not
selling,
that
but they're just letting it roll off, and they're just becoming less. Japan is the largest holder of U.S. treasuries.
Right, but China's treasury ownership is not the same as we owe China money. They're taking our dollars, right? Like this is trade related because they
100%.
sell us more than we buy from them. This is not a debtor situation.
As long as we have a trade deficit,
yes,
you'll always have foreigners that recycle those dollars back into treasuries. Always.
Of course. Okay. I want to go to the re-rating going on in the markets right now because I'm doing this a long time. You're doing this longer than me. This is one of the most violent and sudden re-ratings that I think we've ever seen, which makes sense because everything is a superlative these days. Just the sheer amount of money and the speed of software, everything is bigger, louder, faster, scarier than it's ever been, and that'll probably not change. Facebook lost $200 billion today.
240.
$240 billion, $250 billion in market cap just came out of one stock in one day. Somehow the world didn't come to an end. If I would have told you that we would see that 5 years ago, you would say 1929. Would you not?
So this is what we have to watch for when we look at the rest of the year in terms of these
I'm watching,
market
Peter.
cap. So we talked about how the lower income person is very sensitive to consumer price inflation.
Yes.
The upper end is very sensitive to asset price inflation.
Yes.
And like, I don't know the exact stat, but I think it's like the top 20% of wage earners spend 40% of consumer spending.
Yeah.
And the top 20%, yes, they obviously depend on their income, but they also depend on their stock portfolio, the value of their homes. So if this becomes a drawn out process in the stock
wealth
market,
effect can work in reverse.
then all of a sudden, you know what? Maybe I'll wait to get that boat. Do I really need the private plane if I'm only going to Florida twice a year? Yeah, it's nice when I'm making this much of my portfolios here, but do I need to tighten my belt?
Okay.
So where the stock market ends up through this tightening cycle could then have a direct effect on consumer spending.
So I'm 100% with you. And when I'm on the air on like Closing Bell or whatever, and they have somebody on that says, no, the Fed is not worried about the stock market. Well, it should be if it's not. And I don't believe that it's not, because the Fed has to know that the stock market has replaced the single family home as the biggest driver of consumer sentiment. It has to know that. Everyone has a 401k. Anyone that could buy durable goods, anyone that could make a decision, I want a new dishwasher, basically is in the stock market. So the Fed has no choice but to at least notice when something like the last 2 weeks takes place in the NASDAQ, for example. So I don't know to what extent that shapes policy, but it has to be in the back of their mind, right?
Yes, but they tend to be very reactive to it.
Yes.
Like they'll say, you know what, I don't mind markets fall. I only mind if they fall to a point where it starts to impact the economy. That's what they'll tell you.
But what is the lag between a stock market event and seeing that? Where do you see that first? Retail sales? Same store sales? Like, where would that appear first if you had to guess?
The sales of higher end stuff. If
Apartments?
If Tesla all of a sudden is selling less $80,000 cars,
Yeah.
because maybe someone wants to only spend 50, that's where we'll watch for. But the thing with the stock
That
market
might be more of a crypto
is,
signal, though, than a stock market signal.
It very well could. But it's still the same, like I've made a lot of money in assets.
Yeah.
And asset inflation has benefited me and has directly impacted my consumer spending decisions.
So Snap fell 23% on the day, but thanks to this move in the after hours, which is 55%, it's now up 18% on the day.
What did they say? What was their number? I mean, it must have been like really good.
Do you have a Snapchat, Michael?
No.
Yeah, me neither.
I have one. It's inactive. I don't have any real friends, it turns out. The only way to use Snap is people have to actually want to hear from you and then respond back, which is why it's limited to people like under 30.
Right.
There's nobody to talk to if you're like me, like a strapping 44-year-old man. Nobody wants to Snap with me for any reason.
Yeah, I've only seen it with our
including
kids.
Mike. So, yeah, like you can't make friends on Snap. You have to have friends on Snap.
Right.
It's not good for me. Spotify, 400 million subscribers, 158 million of them are premium, $3 billion in quarterly revenue. Sounds like a nice business. The problem is maybe it's not a $50 billion business. Maybe
Right.
so that's what I mean by re-rating. They had a good earnings report. The Joe Rogan shit, whatever. Like they are genuinely doing pretty well. It's the problem is the market cap they already have going into it. So that was a $400 stock that's now, I don't know where Spotify
It was a
went out.
$70 billion
170
company
now?
that's now 30.
70 to 30. Now does $3 billion in quarterly revenue, does a $12 billion revenue run rate with 400 million subscribers, is that worth 30 or is it worth 10? I don't know anymore. And that's a really big sea change in the market.
Right. And we talked about it before the show started with Microsoft. Microsoft in the year 2000 had the most dominant market presence of any company I know of, with about 85% of the PC software business.
Monopoly.
Greater than all these others combined. Maybe Google with their search business is probably the closest.
And not even close, really.
And not even close. But because, well, the world did change and obviously the internet started to pick up steam, but Microsoft grew their earnings and revenue every single year through the mid-2000s, but the stock fell 50% plus and didn't get back to where it was in 2000 until 2013.
Remember they were paying those monster special dividends. That didn't
Special
work
dividend
either.
did nothing. They implemented a dividend because they didn't have one in 1999.
One of the first big tech companies to do a
Right,
dividend.
and it did nothing because it was a valuation rethink.
Okay, so starting valuation has not mattered for a long time. Really, really matters now. and it has nothing to do with how well or how poorly Spotify might be doing.
Right.
This is bigger than that. This is bigger than that.
And just like you said, we've been doing this long enough. We know sometimes there's a good stock and not a good company, and a good company and not a good stock. They're not always in sync.
You know what's so funny about that? 2 years ago, that they were completely in sync. 2 years ago, the market was taken over by retail traders. And that's exactly the way they invest. They say, I love my Peloton, I'm buying Peloton.
Sort of Peter Lynch like.
My girlfriend loves Lululemon, I'm buying Lululemon. Every fucking one of those trades worked. Like, the more obvious, the better the performance. And that went on for a full year. And nobody waves a flag and tells you this environment's over. But that's what happened.
Right.
And now great companies doesn't really matter.
And also it gets to, the importance of doing also fundamental investing, where, we know whenever you buy a stock, you're buying it because you think the prospects are good. But for those of us doing this long enough, you say, okay, what's my sell point? Well, you're two choices. Do I sell it when it gets to a certain price, or do I sell it when I feel like the fundamentals have changed? And I think there's a lot of retail investors that aren't looking for that inflection point when something may change. Like, we know Peloton was a direct beneficiary of everyone being at home.
Yeah.
And once things started to open up and you started to go to the gym, well, that story started to change. And as a fundamental investor, you have to change your thesis on a stock if the fundamentals start to change. But we know people just overstay their welcome because the stock had worked. And, well, it's working, I'll just continue to ride it.
Yeah. They start getting possessive over the stock.
To me, this is the most interesting question: is where are we in the re-rating cycle? So Facebook was trading 25, 30 times earnings for the past couple of years, in that range, 35 times.
It's not even a lot compared to the
And
rest
now,
of the
and
Nasdaq.
now it's 17. On a forward basis, it's 15. I mean, you could easily make the case that Facebook is cheap. I think it's more difficult to make the case with a company like Netflix, for example, who has done so much in the last 5 years, and the stock has just sucked because investors were paying 200 times earnings 5 years ago. The business is obviously much, much, much bigger today, but the market cap is smaller because now they're paying 35 times, which you could argue is still too much.
Right.
So the question is, where are we? Where are we?
What if it's not innings, but it's more like, I can't tell you where we are in this re-rating cycle until I know when the Fed is done.
Right.
Isn't that the answer?
Absolutely. Because if you're an investor right now and you're looking at this year, you're like, oh shit, excuse me, am I allowed not to say that?
Duncan, get him out of here.
You're looking at, I have the end of QE, then I may have QT along with higher interest rates, and all these other central banks are doing it. I'm not going to get that far in front and try to guess where the bottom is. I'm going to wait to see how things go.
Yeah.
Because that monetary tailwind is now a headwind.
Yeah.
And we just don't know. We saw in 2000 to 2002, things just got cheaper than you would ever think. No one thought the Nasdaq would fall 82%.
They got more expensive on the way up.
And they get more expensive on the way up.
So Facebook did $100 billion in revenue for calendar 2021. Nobody's really reporting that number. That's a big deal.
First time ever.
But so now it's a $650 billion market cap.
Yeah.
Like, I would say 16 times is cheap. The question now is, like I said earlier, let's see how the economy now plays out here, because
16 on the way to 13.
But there's different levers.
Or maybe it stays at 16 or 17, but that earnings number starts to fall. I mean, right now, you look at the earnings estimates, they're still stuck at $220 for the S&P 500. It has not changed a penny.
Facebook is now too big of a platform to not succumb to the overall business cycle. So it used to be they were small, and if advertising budgets were shrinking because the economy wasn't good, Facebook was still eating into them at a rapid rate. They are the advertising budget now.
Right.
So it's like, remember Cisco? At a certain point, they could only grow at the rate of global GDP because that was basically the size of that business.
But so there's Facebook and these behemoths, and then there's Shopify, which you could say, okay, one of the best businesses in the world is going to be has a giant tailwind at its back for the next decade. The stock has been cut in half. You could say, oh, it's $200 billion. Now it's $100 billion. That's cheap. Okay, but the stock is still trading at 25 times sales. Now, it could easily grow into that, right? Like, in 5 years, Shopify could look very stupid cheap right now. But how do we know?
Amazon stock from the peak in 2000 to 2002 fell north of 90%, but their revenues doubled during those few years.
Yeah. Because it wasn't
doubled.
about the fundamentals.
So you could get the fundamentals right and still get creamed.
Right. But to Josh's point with Facebook, and it's going to affect Shopify too, let's just say the economy slows. Well, small business is a big customer for them. You're a small company. Facebook is your only avenue for broad reach advertising. Right. And if your business gets crimped, well, then if you just cut back your advertising spending 5 to 10%, that's going to directly impact Facebook.
It's meaningful to Google too. And during the pandemic, they were citing like, we don't have travel. Travel turned out to have been a very big part of search revenue, like meaningful, like 10% or something. Right. But all of these companies are now too large to be quote secular growth stories in a global economy that's not cooperating.
Right.
It would be impossible for them not to feel those effects at this size.
That's exactly right. So Facebook's PE may stay at 16, but if the earnings number starts to fall, because at the end of the day, that's it with stocks. It's earnings, the trajectory and pace and exact number, and what multiple you pay on it. Now we know we pay a lower multiple on it. Well, what happens now to the EPS number?
What's interesting is that multiple contraction started at the beginning of 21 and continued through the course of the whole year.
Right. It peaked in February when the meme stocks peaked.
Well in advance of the Fed even thinking about tapering. So something in the market was telling people that these companies were not worth paying as much for those fundamentals.
Right. That January, February last year was the ultimate in euphoria.
So J.C. Peretz talks about that being the sentiment time.
That was the apex of euphoria. And then started the summer when Powell at the June meeting said, we're thinking about tapering now.
Yeah.
That's when the yield curve started to flatten out and the multiple compression continued pace once he started to that, and then it sort of just progressed.
Can I say something? Can we I think it would be like a good thing if stocks chill out for a little bit. Like, I don't think it's the end of the world if stocks go flat to sideways, maybe a little bit down for a year or two. We just went up like 18, 31, and 28% in 3 years in a row. Is it the end of the world if stocks go sideways and we catch up?
Good.
That would be great if that was the scenario. But the problem is sometimes when you get an extreme to the upside, markets don't correct by going sideways.
Right.
Okay.
It's just the pendulum swings the other way. The pendulum doesn't stop in the middle.
I also think there's enough new investors, young investors, that are, I'm not saying that they're more afraid than another generation. They definitely have less muscle memory of having bought stocks in a slowdown and have that work out for them 4 years later, because they haven't been here for 4 years. So it's a little bit harder for them, I think, to get through this without maybe doing some stupid
Maybe I'm
stuff.
asking for too much, but if the market could just fall 5% this year and 11% the next year, and the economy not fall apart, I think that would be very good for investors.